September 2008, Lehman Brothers filed for bankruptcy on a Monday morning. By Friday, $10 trillion in global wealth had evaporated. Pension funds collapsed. Mortgage markets froze. Banks stopped lending to each other overnight. In a trading room in Midtown Manhattan, a hedge fund manager named John Paulson was looking at a $15 billion profit. Not from the crash, but because of it. The instruments he used didn't show up on mainstream financial television. Most individual investors have never heard of them and still haven't. Here's the conventional wisdom. When the economy crashes, you protect capital. You go to cash, you go to gold. You wait and you survive. That thinking is exactly why ordinary investors lose twice. Once in the crash and once in the recovery when they enter too late. Crashes don't destroy wealth. They transfer it, always through the same 5 channels. One of those 5 assets gained 57% in a single 6-week period during 2020. Not a single mainstream financial advisor mentioned it to their retail clients. Not once. Asset 1, long-duration sovereign bonds. Most people treat bonds the way they treat dental appointments. They know they probably should have some, they don't fully understand them, and they would rather not think about it. That is a catastrophic misunderstanding of what long-duration bonds actually do during an economic collapse. Here is the mechanism, and it is precise. When an economy begins deteriorating, central banks panic. They slash interest rates. They do it fast and they do it hard. In 2008, the Federal Reserve cut rates from 5.25% to effectively 0 in 14 months. In March 2020, they cut 150 basis points in a single emergency weekend session. When interest rates fall, existing bonds that pay higher fixed rates become extraordinarily valuable. The math is ruthless. A 20-year Treasury bond paying 4% annual interest when newly issued bonds only yield 1% is now worth dramatically more than what you paid for it. Not by a small margin, but by a large one. In 2008, while the S&P 500 fell 38%, the iShares 20-year Treasury bond ETF, ticker TLT, gained 33.8%. It didn't just stay stable, it gained. In the middle of the worst financial crisis since 1929, long-duration U.S. government bonds were delivering returns while equity investors watched their portfolios bleed. Go back further. During the Great Depression between 1929 and 1932, as the stock market lost 89% of its value, long-term U.S. government bonds returned positive gains every single year. That was 4 consecutive years of economic disintegration, with bonds climbing through all of it. The mechanism isn't complicated once you see it. Deflation is the real fear in a genuine crash. When credit contracts, prices fall rather than rise. When prices fall, fixed income cash flows become relatively more valuable because your dollar buys more tomorrow than today. Capital flees equity risk and floods into sovereign debt, pushing bond prices up with extraordinary velocity. The 2020 COVID crash was the cleanest modern demonstration. In the weeks preceding the March bottom, TLT gained approximately 25% in under 6 weeks as equity markets fell 34%. Anyone who understood this inverse relationship had not just a hedge, but an actual return-generating instrument during the most acute phase of the crash. The reason most retail investors have never been told this is structural. Fixed income advisors manage bonds in ways that don't benefit from volatility. Most financial media covers equities. Bonds are boring, they say, until they are the only instrument in your portfolio showing green while everything else is bleeding. The window is always the same. It opens when deflation fear replaces inflation fear in the market narrative, usually when credit markets first begin to seize. It closes when central bank intervention triggers inflation expectations. The investors who understand when that window opens are the ones sitting on gains while retail investors are still in denial. Asset 2, volatility. This is the one most people have genuinely never considered as an asset class. It is also the single most explosive instrument available during an economic collapse. The VIX is the Chicago Board Options Exchange Volatility Index. In simplified terms, it measures how much fear exists in the options market for the S&P 500. When markets are calm, the VIX sits around 12 to 15. When markets are stressed, it rises. During a genuine crash, it does something that looks almost impossible. In February 2020, the VIX was sitting at approximately 14, Calm and complacent, the market was at all-time highs. By March 18, 2020, the VIX hit 85.47. That is a 507% increase in 6 weeks. In October 2008, the VIX reached 89.53, up from roughly 20 at the beginning of the year, a 347% increase. These aren't modest movements. These are seismic. And unlike most assets, volatility doesn't just move. It explodes. The gains are asymmetric in a way almost no other instrument can match. Here is what most people don't know. You can own volatility, not just as a concept, but as an actual financial instrument. Exchange-traded products linked to VIX futures have existed since 2009. The iPath S&P 500 VIX Short-Term Futures, ETN, ticker VXX, provides direct exposure to short-term VIX futures. ProShares UltraVIX Short-Term Futures, ETF, UVXY, provides approximately 1.5 times the daily return of those futures. During the COVID crash, these instruments generated returns that sound fabricated until you see the charts. The reason this knowledge never reaches retail investors is deliberate. Volatility products decay in value during calm markets, a structural feature called contango bleed. Advisors who recommend them to passive investors create client complaints when the instruments slowly erode during low volatility periods. So the industry's default position is simple: don't mention them. But this is not the approach used by institutional traders or the hedge funds running billions in equity books. Every serious portfolio manager runs some form of volatility protection. John Paulson's legendary 2008 trade was at its core a bet that volatility would explode in the mortgage market. He bought credit default swaps, a form of insurance against bond defaults, at a moment when the market was pricing volatility near zero. When the VIX equivalent in mortgage markets detonated, his $1 billion in contracts became $15 billion in profits. The forbidden knowledge is this: volatility isn't just an indicator, it's an asset class. It is one that specifically and reliably moves inverse to the market during acute fear, with leverage built into its structure. The constraint is timing. Holding volatility instruments through a low volatility expansion is expensive and slow. The instrument is not designed to be owned passively. It is designed to be owned surgically during the specific window when credit begins to crack and before the mainstream news cycle catches up to what the options market already knows. The investors who understood this in early March 2020 turned weeks of chaos into generational returns. Everyone else watched their retirement accounts evaporate and waited to read about it in the newspaper. Asset 3, distressed debt. Nobody at a dinner party is discussing this. No financial influencer is posting infographics about it. But the most consistent creators of generational wealth during economic collapses have not been equity investors. They have been credit investors. Specifically, they are buyers of debt that panicking sellers have priced at a fraction of its actual recovery value. Here is the mechanism. Credit markets see forced sellers appear everywhere simultaneously. Banks face capital calls. Hedge funds are hit with redemptions. Insurance companies manage regulatory constraints. These sellers are not evaluating intrinsic value. They are managing immediate survival. They will sell a bond with a 90-cent recovery value for 30 cents if the alternative is insolvency. March 2020 created the purest modern example of this dynamic. Investment-grade corporate bonds, bonds issued by fundamentally sound companies, saw yields spike as prices crashed. The iShares iBoxx investment-grade corporate bond ETF, LQD, fell nearly 20% in 3 weeks. That is 20% for bonds rated A and AA and AA. It was not rational analysis, it was forced selling, and it created an extraordinary opportunity. From the March 2020 bottom through December of that year, LQD recovered approximately 25%. High-yield bonds performed even more dramatically. The iShares iBoxx High Yield Corporate Bond ETF, HYG, fell 24% in the crash and then recovered to new highs within 7 months, returning roughly 40% from bottom to peak. The real money during distress cycles doesn't come from ETFs. It comes from direct debt purchases. In 2009, large institutional investors were buying mortgage-backed securities at 20 to 40 cents on the dollar. The underlying mortgages had elevated default rates built into any reasonable analysis. But even accounting for those defaults, the securities had recovery values far above 40 cents. Investors who bought at distress levels and held through the recovery made 3 to 5 times their investment. Howard Marks, who runs Oaktree Capital Management and has arguably the most documented track record in distressed investing, wrote in his October 2008 memo to clients that the opportunity set was, in his 30-year career, the most compelling he had ever encountered. Oaktree's distressed debt funds, launched in 2007 and 2008, generated returns averaging over 20% annually for the following 5 years. The historical precedent reaches back further than 2008. After the Latin American debt crisis of 1982, investors who purchased defaulted Mexican sovereign debt at 15 cents on the dollar made several 100% returns over the following decade. After the Asian financial crisis of 1997, Korean corporate bonds trading at a fraction of par recovered substantially as the underlying economy stabilized. After Argentina's 2001 default, distressed buyers who understood the legal recovery structure made extraordinary returns over the restructuring cycle. The pattern is identical every time. Fear creates pricing that is entirely detached from fundamental recovery analysis. Institutional investors with patience and capital absorb that mispricing. Retail investors, taught to avoid anything rated below investment grade, never participate. The entrance is always marked by the same signal. High-yield credit spreads over treasuries that normally sit around 300 to 400 basis points widen to 800, 1,000, or 1,200. At that level, the market is pricing in a default rate that implies most of the economy is insolvent. In a modern economy with a functioning central bank, that has never happened. The trade is buying what panic prices as if civilization is ending and holding it until reality reasserts itself. Every single investor who has executed this trade with patience has been right. Asset 4, gold, but not the way you think. Everyone believes they understand gold. Buy it when things get scary, hold it as insurance. This conventional framing isn't wrong, but it is dangerously incomplete. Here is what the standard narrative misses. Gold frequently falls during the initial phase of an economic crash. In 2008, gold peaked at approximately $1,000 per ounce in February. By October, it had fallen to $720. That is a 28% decline during the worst financial crisis in 70 years. Anyone who bought gold as a crisis hedge in 2007 and panic sold in October 2008 did not just fail to protect themselves, they lost money. The investors who understood what gold actually does made fortunes because gold's real function during a crisis is not to protect during the acute phase. It is to protect against the response to the acute phase, against the quantitative easing, the emergency rate cuts, and the balance sheet expansion that always follows a crash like dawn follows darkness. From its October 2008 low of $720, gold rose to $1,900 by September 2011. A 164% gain. This wasn't from before the crash, but from the deepest point of the crash, after most emotional investors had already sold, convinced that a falling gold price meant the asset had failed them. The mechanism is straightforward. Governments respond to crashes by creating money. In 2008, the Federal Reserve's balance sheet expanded from $900 billion to $4.5 trillion over 4 years, a five-fold expansion of the monetary base. In 2020, they went from $4 trillion to $9 trillion in 8 months. When the monetary base expands at that velocity, every existing unit of currency becomes a smaller claim on a fixed pool of real assets. Gold, which cannot be printed or legislated into existence, appreciates proportionally to the expansion of the money supply. There is a precedent that most financial education has quietly buried. When Franklin Roosevelt signed Executive Order 6102 in 1933, effectively confiscating private gold holdings within U.S. jurisdiction and setting the official price at $35 per ounce, he was engineering a controlled devaluation of the dollar against gold. Investors who had structured their gold holdings in jurisdictions outside U.S. reach, where the confiscation order held no force, saw those holdings appreciate 75% in a single legislative decision. The government created the very mechanism that made gold the best returning asset of the following decade. The lesson is not to buy gold before a crash. The lesson is to buy gold when central banks are beginning their response to a crash, when the money supply is clearly accelerating, when real interest rates turn negative, and when the political pressure to print becomes irresistible. That window historically is not at the market top before the crash. It is at the bottom during the crash when panic selling has temporarily disconnected gold's price from its fundamental role as a monetary anchor. Data from every major Western economic disruption since 1929 shows the same pattern. Gold underperforms or falls during the acute phase, and gold substantially outperforms during the monetary response phase. Investors who understand this distinction don't buy gold as insurance against a crash. They buy it as a structured bet on government desperation. They have been correct every single time. Asset 5. Agricultural land. Consider this fact carefully. Between 2007 and 2012, the median U.S. home price fell approximately 26%. Commercial real estate values dropped 30 to 40% in major markets. A diversified stock portfolio was cut in half. The entire American real estate complex was called by the financial press the greatest wealth destruction event since the Great Depression. During that same period, U.S. farmland values rose by an average of 30%. This is not a coincidence. It is not even surprising once you understand what agricultural land actually represents. Farmland is not real estate. It is a productive asset that generates output independent of what the financial system does. A soybean field outside Peoria, Illinois, does not care whether Lehman Brothers is solvent. It produces soybeans. Those soybeans feed people. People need to eat regardless of the condition of the bond market. The USDA tracked Iowa farmland values through the 2008 crisis with granular precision. The average Iowa farmland value in 2007 was approximately $3,900 per acre. By 2012, it had reached $8,400 per acre, a 115% gain. While the broader financial system was experiencing its worst contraction in 70 years, the mechanism ran deeper than mere crisis insulation. During economic dislocations, food security becomes a premium concern. Supply chains fracture. Food price volatility spikes. Every period of acute financial stress in recorded history is correlated with rising food prices because food production requires functioning supply chains that break under financial pressure, while demand remains completely inelastic. You can stop buying a second house, but you cannot stop eating. Go back to the 1930s. The Great Depression is remembered for breadlines and unemployment. For farmers who owned their land outright and carried no debt, the Depression was a fundamentally different experience. While urban workers faced 25% unemployment, farm families maintained food security. They traded produce, sustained local economies through barter, and sat on land that, despite Depression-era price pressure, retained long-term productive value in ways no financial instrument could replicate. There is a harder truth embedded in the agricultural land story that financial media never discusses. It is the only asset on this list that is genuinely orthogonal to the financial system. Long-duration bonds require functioning central banks. Volatility products require operational derivative markets. Distressed debt requires a legal system that enforces recovery. Gold requires a global market to set prices. Farmland requires soil, water, and biological processes that have been running for 4 billion years. No government bond has that track record. The constraint is always liquidity and jurisdiction. Farmland cannot be moved. Governments under sufficient duress can and do seize it. Zimbabwe's land redistribution program between 2000 and 2005 eliminated commercial farming equity almost entirely. The productive capacity of the soil remained, but the ownership claims were dissolved by political decree. The farm still grew crops, but someone else owned them. Structure matters as much as the asset itself. Farmland owned outright in a stable jurisdiction, producing export crops with revenue denominated in hard currency, represents perhaps the most durable form of productive capital in existence. It does not triple in a single crash quarter the way a volatility instrument might. It compounds across decades in ways that traditional financial instruments cannot approach. Precisely because the crises that destroy financial assets tend to preserve and often accelerate the value of assets that feed the survivors. Here is what every economic crash in the last century has confirmed without exception. The money lost in a crash is not destroyed. It changes hands. It moves from the unprepared to the positioned, from the reactive to the structural. You now understand the 5 channels through which that transfer moves. Long-duration bonds that surge on deflation fear before central banks even announce their first rate cut. Volatility instruments that explode at the precise moment retail investors are most confused and least positioned. Distressed debt that panic-priced sellers abandon at fractions of recovery value, while institutional buyers absorb it in silence. Gold that lags the crash and then doubles on the monetary response that every government in history has been unable to resist. And farmland that quietly outperforms while the financial system detonates around it because the land doesn't read the news. The investors who profited most from 2008 were not geniuses. They were not insiders. They were people who had understood these mechanics before the headlines arrived. Every crash in history was called unprecedented by the people it destroyed. It was called entirely predictable by the people who positioned for it. The difference between those two groups has never been intelligence. It has always been preparation. The question isn't whether the next crash is coming. That has never been the question. The question is which side of the transfer you're on when it arrives. If this analysis changed the way you look at the hidden machinery of global wealth, subscribe to our channel and like this video. We are digging into the financial history they tried to bury and the patterns the mainstream ignores. Secure your future. The next vault of knowledge will open soon.